Welcome to the deep dive.
Great to be here.
Today we're plunging into something really significant, corporate tax in the UAE.
Yeah, a massive topic.
Because we've always known the UAE as, the tax-free zone, right? A haven.
That's been the image for so long, tax-free paradise.
But that's changing. Back in 2023, they actually introduced a federal corporate tax.
It's a huge deal, not just a minor adjustment.
Absolutely. A monumental shift, really, for businesses, individuals, anyone operating there.
Or even thinking about it.
Exactly. So our mission today, we've got a stack of sources, official government stuff, case studies, expert guides, and we want to really unpack this.
Get into the nitty-gritty.
Yeah, extract the key things you need to know, the what, the who, the how, and maybe most importantly, why it matters to you.
Whether you're already there, planning to go, or just watching these global economic shifts.
Right. So this historic shift, the investment was January 2022, you said.
That's right, Jan 22. But it actually kicked in for businesses starting their financial year on or after June 1st, 2023.
Okay. So for a lot of companies, their first taxable year might be this current one, like Jan 1, 2024 to December 31, 2024.
Exactly that. So it's very much live right now.
It's just fascinating, the UAE making this pivot. Why now? What's the bigger picture here?
Well, it's not just about tax revenue, though that's part of it. It's more strategic.
Okay.
It's about the UAE really cementing its place on the global stage, showing it's a mature, transparent economy.
Aligning with international norms.
Precisely. The key aims are, yes, diversifying revenue away from just oil, supporting public finances, but also meeting global tax standards.
Like the OECD stuff we hear about.
Exactly. Things like transparency, accountability, preventing harmful tax practices. It boosts the UAE's reputation as a serious global business hub.
It makes sense. And there's specific legislation behind this.
Oh, yes. It's governed by Federal Decree Law Next 60 of 2023, which tweets an earlier law. And the body in charge is the Federal Tax Authority, the FTA.
Yeah.
They handle administration, collection, enforcement.
Right. Okay, so that's the why. Let's get into the what, the actual numbers. What are the tax rates we're talking about?
Okay, the standard rates are pretty clear-cut.
Okay.
It's 0% on taxable income up to 375,000 AED.
Okay, so a decent threshold for smaller profits.
Exactly. Then, for taxable income above AED 375,000, it jumps to 9%.
9%, okay. That seems relatively competitive globally still.
It is. But then there's a twist for the really big players.
Ah, the multinationals.
Right. There's a different rate. It's actually unspecified yet in the law, but linked to Pillar 2 of the OECD's BEPS project.
Okay, Pillar 2, sorry to interrupt, but can you just quickly clarify what that means for people who aren't deep in tax treaties?
Sure, no problem. Pillar 2 is basically the OECD's push for a global minimum corporate tax.
Right, I've heard about this.
The goal is to stop huge multinational corporations. We're talking those with consolidated global revenues of $750 million or more.
The giant.
Exactly. To stop them shifting profits to super low tax places to avoid paying tax altogether. It sets a floor.
What's the floor?
A minimum effective tax rate of 15% on their global profits. This applies if they hit that $750 million threshold in at least 2 of the 4 previous years.
Okay, 15% minimum globally for the big guys. And when does that specific part apply in the UAE?
That's set to apply from January 1st, 2025 for those relevant MNEs.
Got it. So if I'm, a regular SME in the UAE, not a 750 million giant, does this Pillar 2 thing affect me indirectly at all?
That's a smart question. Directly. But indirectly, yes, it signals the UAE is serious about playing by global rules.
Creates a more stable environment, maybe?
Exactly. It adds to the overall predictability and reputation for good governance, which benefits everyone.
So beyond the MNEs, who else falls under this standard 0% and 9% structure? Is it really wide-reaching?
It is pretty broad, yes.
Yeah.
It applies across all the Emirates.
Okay.
It covers basically all businesses and individuals who are conducting business activities under a commercial license.
So sole traders, too, if they have a license.
Yes. And free zone businesses, though we need to talk more about their specific rules.
Definitely. What about foreign companies?
Foreign entities and individuals only get caught if they're conducting trade or business in the UAE in an ongoing, regular way, not just, say, passive investment.
Okay. And specific sectors? Banking, real estate?
Yep, banking operations are in. Businesses doing real estate management, construction, development, agency, brokerage activities, they're all covered too.
Wow. Okay. That's quite comprehensive. So the flip side, who is not subject to this, are there significant exemptions? especially for individuals.
Yes, and this is really important for individuals living and working there or investing.
It's exempt.
Okay, first off, we're
Yeah.
salary.
Yeah.
Individual salaries and other income from employment are completely exempt.
Big relief for many, I imagine.
Huge. Also, interest you earn from your personal bank account or savings schemes, exempt.
Okay.
If you're a foreign investor, your income from dividends, capital gains, interest, royalties, other investment returns, also exempt.
What about real estate investment?
If an individual invests in real estate in their personal capacity, not through a company structure necessarily, that's exempt.
And personal share trading.
Same deal.
Yeah.
Dividends, capital gains, other income individuals get from owning shares or securities, personally exempt.
So it really targets business activity, not personal wealth or passive returns for individuals.
That's the core principle.
Right.
There are other exemptions too. Businesses extracting natural resources, like oil and gas, they stick to their existing emirate-level taxes.
Right.
Dividends and capital gains a UAE business earns from its qualifying shareholdings are exempt.
Okay, specific definition there, I guess.
Yes. And qualifying intra-group transactions and reorganizations are exempt if conditions are met. Plus, government entities might be automatically exempt too.
It seems they've tried to carve out personal income in certain strategic areas quite clearly.
They have. It's focused on active business profits.
Now, you mentioned free zones earlier. We absolutely have to talk about the mainland versus free zone distinction. It's so fundamental to the UAE business structure.
Couldn't agree more. It's probably the most critical strategic decision for many businesses setting up there.
So, just briefly, remind us of the core difference.
Sure. Mainland companies operate under the standard federal and local laws, can trade freely within the UAE and internationally. Often need a local sponsor, historically, though that's changing too. Think Dubai City, Sharjah City.
That's standard business setup.
Right. Free zones are like designated economic areas, often geographically defined, with their own rules and regulator.
Like JFZA or DIFC.
Exactly. They offer big incentives. 100% foreign ownership was always a big one. Repatriation of profits, often specific tax breaks. But the trade-off is sometimes limits on doing business directly with the mainland market.
Okay. So how does this new corporate tax impact that huge difference? Can free zone companies still get 0% tax?
Yes, but, and it's a significant but,
Uh-oh.
a free zone entity can still qualify for a 0% corporate tax rate, but only on its qualifying income.
Qualifying income. Okay, there's that term again.
Exactly. Any income that doesn't meet the qualifying definition, what they call non-qualifying income, that gets taxed at the standard 9%.
And is there that AED 375,000 threshold for them?
No, that's key. For free zone businesses, there's no 0% threshold on non-qualifying income. If it's non-qualifying, it's taxed at 9% from the first term.
Right. So getting that qualifying free zone person QFZP status is absolutely vital for them.
It's everything if you want the 0% rate.
So what hoops do they need to jump through? What makes them a QFZP?
Okay, there's a list of conditions, and they have to meet all of them throughout the tax period.
Let's hear them.
First, adequate substance in the free zone. Real presence offices, staff, activities happening there.
No shell companies.
Definitely not.
All right.
Second, they have to earn qualifying income. We'll define that next.
Okay.
Third, they must not choose to be subject to the standard 9% tax regime. You have to stay within the free zone rules.
Makes sense.
Fourth, this is a big one, their non-qualifying income must be minimal. It can't exceed either 5% of their total revenue or AED 5 million, whichever amount is lower.
Wow. Okay. That's a very low tolerance for non-qualifying activities.
It really limits how much business they can do, for example, with the mainland market directly, if that income isn't qualifying.
What else?
They need proper financial records, audited to IFRS standards, the international accounting rules.
High standard of bookkeeping.
Yes. And they have to comply with transfer pricing rules and documentation if they have related party transactions.
Just like mainland companies.
Exactly. And finally, they need to meet any other requirements the specific free zone authority might impose.
That's quite a list. Which of those do you see businesses maybe struggling with the most? Where's the common trip-up point?
Often it's the adequate substance, proving their activities genuinely based there and managing that non-qualifying income threshold.
Slipping over the 5% or 5 million limit by mistake.
Easily done if you're not tracking carefully. A few unexpected deals with mainland clients, for instance, could tip you over.
Okay, so let's define qualifying income. What kind of activities get the green light for 0%?
The government has listed specific activities, things like manufacturing or processing goods,
Okay.
holding shares in securities, owning, managing, operating ships, reinsurance services.
Financial services seem prominent.
Yes, Fund management, wealth management, investment management services, also providing headquarter services, treasury functions, or financing to related parties.
Intra-group stuff.
Right. Financing or leasing aircraft is another. Distributing goods or materials in or from a designated zone that's important. Logistics services, too. And activities considered ancillary to these main ones.
So it covers quite a range, but it's specific.
Yeah,
And non-qualifying is basically everything else.
pretty much. Especially earnings from activities outside the zone or dealings directly with mainland businesses if it doesn't fit those categories. Also, transactions with individuals generally, unless related to qualifying activities, and owning non-commercial property outside the free zones.
And the penalty for messing up, if a company fails to meet any of those QFZP conditions.
It's harsh. They lose the QFZP status and therefore the 0% rate, not just for that year, but for the subsequent 4 years as well.
5 years at 9%. Ouch.
Yes. All their income gets taxed at 9% for 5 years. So compliance is absolutely critical. A small mistake can be very costly.
Definitely raises the stakes. Before we move to registration, anything on withholding tax? Does that differ between mainland and free zone?
Good point. Actually, to keep things attractive, the UAE currently has a 0% withholding tax policy across the board.
0% on domestic and international payments.
Yes, for both mainland and free zone entities. It simplifies things and encourages payments flowing in and out.
Okay, that's a significant plus. So the mainland versus free zone choice really hinges on your target market and activities weighed against these QFZP rules.
Absolutely. Local market focus versus international, and can you meet those strict QFZP conditions if you go the free zone route?
Now let's talk about something potentially helpful. Small business relief, or SBR. Sounds like a lifeline for smaller players.
It definitely is. The government introduced it specifically to help startups, small businesses.
How does it help?
The main goal is to reduce their corporate tax burden and their compliance costs. Make that transition into the new tax system a bit easier, recognizing they have fewer resources.
It makes sense. So who qualifies? Is it automatic?
Not automatic, you have to elect for it. To be eligible, first you need to be a resident taxable person in the UAE.
Which includes?
Companies incorporated in the UAE or foreign companies effectively managed and controlled from the UAE. Also, natural persons individuals conducting business in the UAE.
Okay. And the main condition?
Revenue. Your total revenue for the tax period, and crucially, for all previous tax periods ending on or before December 31st, 2026, must not exceed AED 3 million.
3 million AED ceiling. That's about, what, around 800,000 US dollars?
Roughly, yes.
Yeah.
It captures genuinely small businesses.
And you mentioned previous tax periods. What's the catch there?
The critical point is if you exceed that AED 3 million threshold in any relevant tax period or any previous one back to the start date, you lose eligibility for SBR, not just for that year, but for all subsequent years too.
So once you cross it, you're out for good.
Correct. So you need to monitor your revenue very closely if you're near that limit.
Okay. If you do qualify and elect for SBR, what are the benefits? Is it just 0% tax?
The 0% tax is the main one, yes. Eligible businesses are treated as having no taxable income for that period.
Which is great for tax flow.
Absolutely. But almost as important is the simplified compliance.
Ah, less paperwork.
Much less. No need to calculate taxable income in detail. Simplified tax return filing. Relaxed record-keeping requirements. You can even use cash basis accounting instead of accrual.
That's a big help for small operations.
It is. And you don't need to worry about complex transfer pricing documentation for related party transactions during the SBR period.
So real savings in admin time and costs, too.
Definitely. Allows them to focus on actually running and growing the business.
Are there businesses that cannot claim SBR even if their revenue is below 3 million?
Yes, a few specific exclusions.
Like who?
Those big multinational enterprise groups, the M&Es, subject to Pillar 2 rules with over 750 million global revenue, they're out.
Makes sense. They're not small.
Right. Also, qualifying free zone persons can't claim it because they already have access to the 0% rate on their qualifying income.
Okay, can't double dip.
Exactly. Financial institutions and holding companies are generally excluded too.
And what about gaming the system, like splitting a business artificially?
The FTA is wise to that. If they see an artificial arrangement purely designed to split revenue and stay under the AED 3 million just to get the tax advantage, that can be challenged and denied.
Good to know. So even if you qualify for SBR and elect for it, you're not completely off the hook with the FTA, right? There are still some obligations.
Absolutely. SBR simplifies things, it doesn't eliminate them. You must still register for corporate tax with the FTA.
Okay, registration is mandatory for everyone.
Yes, you still need to file an annual tax return. That's actually how you formally elect for SBR each year.
Ah, okay. You claim it on the return.
Correct. And you still need to keep proper books and records. They need to be good enough to support your claimed revenue figures if the FTA decides to audit you.
So you need proof you were actually under the 3 million.
Precisely.
Huh?
And one other point. If you claim SBR for a tax period, you can't claim other tax benefits for that same period, like carrying forward tax losses from previous years.
Okay, it's one or the other.
Right. It's generally very beneficial, but you still need to stay on top of the basic compliance.
Right. Okay, let's shift gears to the practicalities. Registration, everyone needs to do it. How does it work? Is it a nightmare? You mentioned the Ameritax portal.
Yes, Ameritax is the FTA's online portal. And honestly, for a government system, it's designed to be pretty user-friendly.
That's good to hear. How do you start?
You log in, either with existing tax credentials if you have them, or using UAE Pass, which is like a national digital ID.
Okay.
If you're new, you sign up. There might be two-factor authentication, standard stuff. Once you're in, you'll see your taxable person profile, or you can create one.
Is it one profile per company?
Yes. Then you find the corporate tax tile and click Register.
Straightforward enough.
Before you start filling things in, it gives you guidelines and instructions, tells you what documents you'll need. You have to tick a box saying you've read them.
What kind of documents?
Depends if you're registering as an individual doing business or a company. For an individual, usually Emirates ID or passport. For a company, you'll need the ID passport of the authorized signatory, plus proof they're authorized like a power of attorney or maybe the memorandum of association.
And technical limits, file sizes.
Standard stuff, PDF, DOC, DOCX preferred. Max file size is 15 BOB per file.
Okay. Then the actual application.
It's broken down into about 5 main sections. There's a progress bar. You fill in mandatory fields to move on.
What are the sections, broadly?
Entity details, like are you a public joint stock company, a private company, etc. Country, incorporation date, your tax period, identification details, your main trade license info, business activities, owner details, anyone with 25% or more ownership. If you have UAE branches, you add them here too.
Wait, if I have branches in different Emirates, do I register each one?
No, that's important. Only one CT registration is needed for the head office or main entity, covering all its UAE branches.
Okay, good. What else?
Contact details your registered business address. Crucially, use your address, not your accountant's address. And authorized signatory details who can sign off, their ID, proof of authorization.
Can you save it and come back later?
Yes, there is a Save as Draft button. When you're done with the section, click Next Step.
How long does it take, roughly? And does it cost anything?
They estimate about 30 minutes if you have everything ready. And no, registration itself is free.
Okay. And the final step.
A review screen, summarizing everything. You check it carefully, tick a declaration box saying it's all correct, and hit Submit.
And then?
You get a reference number. The FTA reviews it. They'll email you if it's approved, rejected, or if they need more info. You can also track the status on your Ameritax dashboard.
Sounds manageable. What about deadlines? Are there penalties for registering late?
Yes, absolutely deadlines.
Yeah.
And yes, penalties. The deadlines are tiered based on the month your trade license was originally issued, regardless of the year.
That's an unusual way to do it.
It is, but it staggers the workload for the FTA. For example, licenses issued in January or February had a deadline of May 31st, 2024. March-April licenses were June 30, 2024. May licenses, July 31st, 2024, and so on through the year. December licenses have until December 31st, 2024.
So you need to know your license issue month. What if you have multiple licenses issued in different months?
Good question. You go by the deadline associated with your earliest issued license.
Okay, the oldest one sets the date. And the penalty for missing your deadline.
It's an administrative penalty of AED 10,000, so definitely worth getting it done on time.
10,000 dirhams. Yeah, you don't want to pay that just for being late. What about the deadline for actually filing the tax return and paying the tax?
That's different. Once you're registered, you have 9 months after the end of your relevant tax period to file your first corporate tax return.
9 months post year end.
Yes, and any tax due must be paid within that same 9-month window. So for most companies with a December 31st year end, their first filing deadline will be September 30th, 2025.
Okay, so there's some breathing room after the year ends. And record keeping. How long do you need to hang on to documents?
7 years. You need to keep all relevant records and documents for 7 years following the end of the tax period they relate to.
7 years. That's standard for tax in many places. Crucial for audits, I guess.
Absolutely critical for compliance and if the FTA comes knocking.
So registration is one hurdle. But Ongoing compliance. That sounds like where the real challenges might lie for businesses day to day. What are you seeing?
You're spot on. Getting registered is just the start. The ongoing part has its own challenges.
Like what?
Well, first, the rules are still quite new and evolving. There are clarifications and updates coming out, so just staying current is a challenge.
Keeping up with changes.
Exactly. Then, the tax structure itself, while maybe simpler than some countries, still has complexities, different rules for different industries, those free zone nuances, exemptions. Navigating that takes effort.
And the documentation.
That's a big one. Maintaining really detailed records, not just basic bookkeeping, but evidence for intercompany deals, financial statements prepared properly, proof for why certain income is exempt. It's time-consuming.
Prone to error if you're not careful.
Very much so. Especially for multinationals, that transfer pricing piece is under scrutiny.
Making sure transactions between related companies are priced fairly, at arm's length.
Precisely. Getting that wrong can lead to significant tax adjustments and liabilities.
And VAT is still separate, right? Does that add complexity?
It does. While VAT is different from corporate tax, businesses still have to manage VAT compliance, correct accounting, invoicing, claiming input tax credits. Misinterpreting VAT rules can also lead to penalties, adding to the overall compliance burden.
And are tax audits becoming more common?
We expect them to. As the system beds in, the government will naturally strengthen enforcement. Businesses that aren't compliant are likely to face more audits.
Okay, so let's imagine a company, maybe a medium-sized trading business in Dubai, facing all this for the first time. What did that actually look like on the ground? Any insights from practice?
Yeah, we saw quite a bit of initial, well, panic perhaps,
Yeah.
or at least significant concern. For a typical mid-sized retailer, say XYZ Trading LLC,
Okay.
their first reaction was needing to understand everything quickly, rates, records, free zone rules, if applicable.
Yeah.
They often realized their existing, maybe simpler accounting systems weren't quite up to scratch for CT
You
reporting.
needed an upgrade.
Often, yes. The aha moment for many like them came when they decided to get help, maybe engage a specialized tax advisor or corporate services provider.
Makes sense. You can't be an expert in everything.
Exactly. And that partnership didn't just get them through the first filing. It often led to improving their whole financial management system, making processes more robust. It turned a compliance burden into an opportunity to actually strengthen their financial controls.
So, turning a challenge into an improvement. That's a positive way to look at it. Based on that, what are the key strategies for businesses to overcome these ongoing challenges?
Okay, first, echoing what we just said, stay updated. You have to actively monitor FTA announcements, maybe attend workshops, definitely consult with tax professionals.
Be proactive about knowledge.
Absolutely. Second, effective tax planning. Don't just react. Think ahead. How can you legitimately minimize liabilities using the available exemptions, incentives, deductions? Manage that transfer pricing risk proactively.
Strategic thinking.
Third, invest in your internal systems. Robust accounting software, maybe automated processes for reporting and documentation. This streamlines things and reduces errors.
Better systems, fewer mistakes.
Fourth, don't be afraid to engage experts. Regular internal or external audits, getting advice from corporate tax consultants. They can spot issues early, tailor strategies, ensure your records are solid.
Get professional help when needed.
Definitely. And finally, don't neglect the other taxes like VAT. Ensure your VAT returns are accurate, records are good, and you're correctly claiming exemptions or credits. It's all part of the overall compliance picture.
Right, it all interconnects. Phew. Okay. We've covered a lot of ground today.
We certainly have.
We've really done a deep dive into this new UAE corporate tax world. From the basic rates and why the UAE did this, to the super important differences for free zones.
That QFZP status being key.
Absolutely. And the small business relief providing a cushion for smaller players. We walked through the AmeriTax registration process.
And those crucial deadlines.
Yep. And finished up by looking at the ongoing challenges and, importantly, how businesses can tackle them strategically.
It really is a landmark change for the UAE.
Yeah.
Moving towards global standards, but trying to do it in a way that keeps the country attractive for business.
That balance seems key. Competitive rates, specific relief programs like SBR, the 0% for QFZPs.
Exactly. They're aiming for that sweet spot.
So for you listening, understanding these details isn't just about ticking compliance boxes. It's fundamental for planning strategically, whether you're already operating in the UAE or considering it.
It really shapes your business model, your structuring choices, your operational decisions.
Definitely food for thought. How does this new tax regime change the game for your potential ventures or your current operations in the UAE? What opportunities might it open up, or what challenges does it present that need careful navigation?
It's a question every business connected to the UAE needs to be asking right now as they navigate this evolving global economy.